I've been in the financial planning industry for a little over 12 years now, and during that time I've come across and I've personally tried many different methods of investing and many different methods of portfolio construction. But I've arrived at what I believe to be the most appropriate approach for the long term, and that is the core plus satellite approach. This involves creating the backbone or the foundation of your portfolio with index funds, and then using targeted positions around the index to try and get a little bit of alpha in your portfolio. So the index is the core of your portfolio and the targeted positions are the satellite. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about the core satellite approach to investing. So when it comes to establishing the core of the portfolio, we already know that we're going to be using index funds. And the reason why we want to do this is because index funds offer us a high level of diversification at a very low cost. And there is also a lot of research out there that suggests index funds are a very good way to invest. Every year, the S&P Dow Jones Indices releases what they call the SPIVA scorecard. Now, this is a study that compares active management, so those guys who are trying to outperform the market, to passive management, taking an index-based approach. And the results are quite compelling. So basically, over a 5-year period, only 20% of active managers will actually outperform their relevant benchmark. Now, this tells us that active management and stock picking is a very hard game to win because there are some very smart people playing at this game, and a lot of them get it wrong. And so therefore, in my opinion, at least 50% of your portfolio should be made up with index-based funds. Now, there's no hard and fast rule as to how much should be made up of index and how much should be made up of active management, but for my personal preference, I think 50% as a minimum in the core of your portfolio is a very good starting point. Now, there are many different ways in order to get your index exposure in your portfolio, and the way you do it is largely going to be dictated by the platform you're using to manage the funds. So for instance, if you have an online brokerage account, you're likely going to use ETFs to get your index exposure. But if you're investing through something like an investment bond, then you're more than likely going to be using managed funds to get that same index exposure. Now, if you're not a very confident investor, then putting 100% of your portfolio in the core holdings is okay. In fact, I'd go as far to say that if you're not familiar with investing and you're not comfortable with investing, then you're probably better off leaving everything in the core of your portfolio. But for those of you who do want to take it to the next level because you're a little bit more experienced, then let's look at the satellite holdings now. The satellite holdings bring alpha to your portfolio. And when I say alpha, I mean the ability to outperform the index. And in addition to outperformance, the satellite component of your portfolio is going to allow you to target specific portfolio outcomes. For instance, you might want income. And in that case, the satellite component is going to be focused around high yielding dividend paying stocks. In order to get the satellite exposure in your portfolio, then you can really do this one of two ways. You can either select individual stocks or individual holdings yourself, or you can put some money with an active fund manager. Now, an active fund manager is going to give you a lot of diversification through a single holding, and you're going to get the expertise of that manager and their team. So really, it is a great way to get some satellite exposure in your portfolio. Now, if you do use an active fund manager, there will be some additional costs because obviously an active fund manager charges a management expense ratio for their expertise. So if you really wanted to get rid of that cost, you could pick individual stocks yourself, but just bear in mind that this probably will add to a little bit more concentration risk in your portfolio. The performance of your satellite exposures is really going to determine how well your portfolio performs in comparison to a relevant index. Now, remember what I said earlier about how I believe you should have 50% of your portfolio at least in the core of your portfolio. This allows for up to 50% in the satellite holdings. So if you're fairly confident in what you're doing, you can get close to that 50% level, but the less confident you are, then you pull that satellite exposure back. And just remember, when it comes to putting together that satellite component of your portfolio and selecting those stocks, don't confuse skill with luck in a bull market. Now that we understand the reasoning behind why we're using the core satellite approach to investing, we now have to look at your individual asset allocation. And this is how much you're going to allocate to each asset class. So things like Australian shares, international shares, property, infrastructure, cash, all those kinds of things. Your asset allocation is largely going to be dictated by your tolerance to risk. So for instance, if you have a very high tolerance to risk and you're comfortable with seeing fluctuations in your portfolio, then you can have a large exposure to those growth assets. So things like your international shares, Australian shares, property and infrastructure. On the other hand, if you're fairly risk adverse and preservation of capital is your main priority, then you're gonna want to have more exposure to the defensive component of your portfolio. So that's like your fixed interest and your cash. I personally believe that asset allocation is one of the most important factors in portfolio construction, because it's really going to dictate how your portfolio performs in different market conditions. Now, in order to be good at portfolio construction, asset allocation, you really need to have a good understanding of macroeconomics, and this is something that I'll touch on in future videos. One thing I found in my day, however, is that Australians tend to be overweight in Australian equities. And this makes a lot of sense, right? Because we can access them easily through the ASX. And also, we see the companies around us in our everyday life, so we understand the companies a little bit better. But just remember that Australia makes up 2% of the global GDP, and therefore it may not be wise to have all of your portfolio just in Australian equities. As an investor, you're typically trying to maximize your investment return, and it can be very hard to do that without an appropriate international exposure. Because here in Australia, we just don't have a lot of those companies that are big global brands. So things like Microsoft, Apple, Facebook, Amazon. They're all great companies, and if you don't have them in your portfolio, you're probably missing out on quite a few opportunities. So for each asset class you do choose to invest in, it is normally appropriate to take the core satellite approach to each individual asset class. Now, the only asset class that I think that active management is better than passive management is in the fixed interest space, and that's simply because I believe a good active fixed interest manager is going to be able to preserve your capital much better than an index-based approach can. When developing a portfolio, we bring with us a lot of biases, and that gets reflected in the assets we hold, whether we realize it or not. And now, it is always good to have a little bit of your own flair in a portfolio, but too much of a good thing can leave you susceptible to downside risk. By using the core satellite approach, we've put in place some ground rules, which is going to eliminate some of the bias in our portfolio and hopefully give us a much more rounded portfolio, which is better suited to changing market conditions. You can still have some of your flair in the satellite exposures, but the index exposures, which make up the core of your portfolio, is going to keep you on solid ground. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up, and I will see you guys in the next one.